Hey, what's happening, guys? Welcome to this video. So in this video, I wanted to make a video about Tradingview. I want to show you my chart that I use, and I want to explain to you how I use it and also why I use it. So let's get to it. You know, on Tradingview, I use this as an analysis platform in charting. So I'm sure if you've watched my other videos, you do know that I view charts as a form of understanding the context of the market. I do not use charts to execute orders or read the real-time information at all. They're simply a form of context. So once you understand that, you might be in a better position to know how to use them properly. What I mean by context is this. So I use a form of market profile analysis. If you want to learn more about it, go look at E-mini OS on YouTube. Trust me, the information is more than worth it, and it's going to pay for itself in the future. If you're dedicated, that is. Okay, so in this video, guys, I'm not going to cover a lot on market profiling techniques and that, and I basically explain to you how I use these charts and how they help me, basically, okay? So let's get to it right now. So like I look at volume profiles, total profile, session profile, and I want to understand the auctioning process of the market. Where is the market perceiving fair value? Okay, that's the big one. In order to have an edge buying, you want to buy below fair value because you're betting that the market will eventually reverse back to fair value. If the market is exploring new areas, then that is called imbalance. That is not fair value. The market is trying to find fair value. In that case, you never want to be fading one-sided moves like we had today, for example. When the market is just collapsing and it's not finding value at any point, you do not fade that. It's simple rule of thumb. And this is the type of trading where if you have the ability to get in and out quickly and scalp that thing, you just get in, momentum, take a profit, put a break-even stop. And if you get a runner, you get it. If you don't, you stop break even. It's like win or scratch. Literally, if you know what you're doing, free money sometimes. Other times, trading is pulling teeth, but we're not going to go there. Okay, so how do I use these charts from Tradingview? I'll show you exactly how. First of all, I use a time frame chart, and the time frames I use the most are the daily chart and 30-minute, 15-minute. Those are like the main time frames. Okay, you can also see that I do have a Fibonacci here. I'll show you how I use that probably towards the end of the video. If you stick around, don't forget to leave a like on the video, guys, if you made it this far. Cheers. Okay, so the first chart's a time frame chart. The other chart is a range chart. And the reason I prefer a range chart is because this is a great way to see the immediate auctioning process of the market without being constrained by time. Okay, I do not care about time when the market is auctioning at the speed that NQ trades, for example. So when you have a range chart, basically what happens is whenever the market moves the specified range that you selected, then it's going to create a new bar. Okay, in this case, I have this one set to 16. So whenever it moves up or down 16 ticks, it creates a new bar. That's the point of a range chart. So this chart does not care about time. All it cares about is movement of the price. So in this case, on a time-based chart, this would probably be really ugly from 12 o'clock until 12:15. But what I can see here clearly on this range chart is that the market was balancing in this area. So there was no indication of which direction to trade. In fact, if you wanted to trade based on this balance area, you would just sell towards the higher part of it and buy towards the lower part of it. And now what we're seeing is a slight imbalance. Value is now changing. It is now moving away from this value and it's creating value somewhere else. Again, the range chart is simply to see the immediate rotations of the market. So what I've got here on this range chart is standard deviation lines. So what they do is they calculate the mean over the specified range of bars. This yellow one is 80 bars and the white one here is 20 bars. And what it does is it will plot a trend line. If the mean went up over 80 bars, then the trend line will be upwards. If the mean was sideways for 80 bars, then you'll see it's like a sideways channel. So this thing moves by itself, and it's a good reference point just to see the major trend of the market, right? So if the major trend is clearly up, you have to have a good reason to go short, basically. So, you know, it's just a way of filtering out certain things. So when I started trading, I often got into those scenarios where I was trying to sell the market as it was trending higher. And guess what? I kept being wrong all the time. I'm sure you've been there, especially if you're new to trading. Market goes higher and higher. Guess what? You keep trying to sell it or buy puts. And the next day you wake up, you're offside again. Your puts are worth nothing. Don't get into those cycles, guys. Your goal is to follow the path of least resistance. And this chart helps me do that. And I'm trying to explain to you how, but I'm not going to give you every detail either. So again, here on the right side, a volume profile. So basically what the volume profile tells me is where's the market perceiving value. So like I just showed you, we had value here, we moved higher, now we have value here. The market is auctioning here. When we move away from this, I want to see, are the sellers aggressive enough to push this back down, or are we likely to reject that and accept this price as a new area of fair value? So acceptance, rejection, that's the market's process. That's sort of how these markets work. Now again, a short-term range chart like this will not always be reliable. Sometimes you need to understand the bigger picture to some degree. That's why I use these 30-minute and 15-minute charts to understand the battle zones. So one way of giving yourself a good context to get the battle zones is using one-time framing. If you don't know what that is, go look it up. One-time framing is a very simplistic way of looking at the market and saying, okay, who took control of the market and where did they take control from? So like you could say something like this. So you look at these 30-minute bars and you could say, okay, we're moving sideways, and then the first time the bulls took control of the previous bar was around here. So you can see this bar closed above the high of that previous bar. Therefore, you could say, all right, now this is like our new line in the sand for the bulls to hold. This is basically where the bulls took control of the market. Again, like I told you, that's a very simplistic way of looking at it, but one-time framing can be a good way to see when the market is trending, and just don't fade it. Don't fade the market when it's trending. Please, don't get into that cycle. Honestly, I think this is one of the reasons why a lot of traders blow up, is because they think the higher it goes, the more money they're going to make shorting it. But in reality, the higher it goes, the more people try to short it and then eventually get squeezed out. When you see every single bar one after another with a higher close, and even if it tests the low of the previous bar, you'll always get it coming back in and closing higher, and fair value is always moving higher every day. You don't fade that, all right? So this is called one-time framing up. 1, 2, 3, 4, 5, 6, 7. See this bar, we tried it. On this day right here, you would have said, okay, the bears tried to control this. Now I want to see, can they control it further? Okay, so that's where you go more in depth. You look at the footprint and you look at the order flow, and you see how are the buyers and sellers interacting at these prices. Are the sellers being aggressive enough that they can actually push this market down? In this case, the answer would have been probably no if you would have been reading the tape. And in this case, the market continued higher, 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 higher. And then we finally saw one day where the sellers just took control of the market completely. So a day like this, that's imbalance. Do not fade it. All right, you always want to be on the right side of fair value. Okay, if fair value is moving lower, you should be short biased. If fair value is moving higher, you need to be long biased. That's just how it is. If sellers are selling into the market, they reach a key battle zone and now they can't push it lower, well, guess what? You should be long biased. So it's like kind of how I use these charts to give myself a bit of context. And guys, I know I'm not going into a super amount of detail, but hey, this is YouTube. Okay, so the last thing I'll show you guys in this video that I use for context and how I use Tradingview is I'll use Fibonacci extensions, and I'll show you exactly how I do that right now. So like, let's extend a Fibonacci based on the first 5-minute bar of today, okay? And what you're gonna see is that you get extensions at multiple levels. Now, what I noticed, maybe today you don't see that, but you actually do kind of see that with this extension. But what I noticed about this is that they tend to line up with important supply and demand zones. And I do not know how they do that, but they just do. If you understand market profiling at all, and you try this, put the fib extension on the first 5-minute bar of the day. Sometimes I'm blown away with how these extensions line up exactly with important supply and demand zones. For example, here's the range of the open. We consolidate here. We can't trade lower. But again, what's this doing? It creates a nice obvious low down here. Sooner or later, we trade it. And basically, this is our first take profit zone on the trade. In this case, the market followed through a lot. Normally, what you'll see is some form of two-way trading around these zones. And I'll show you another example from a different day just to show you that. So I go to this day right here. So this would have been February 5th. 2021. In this example, the market did find a lot of two-way trading around this zone and eventually held it and then auctioned higher after that. But now for fun, let's just reverse that and look at the opposite end of that. And we can see, you know, once the market started to auction higher, let's look at how it behaved. At the first fib extension, you can see we shot up higher. We reached almost the second one. In this example, just look at how the market reacts around the price. You can see we retested it there, auctioned lower, couldn't trade lower, auction back through it. Point of this is these levels are not end all be all. And you can see sometimes the market respects them very well. Like look at this. Here, and then up here, and then up here, we're auctioning two-way trading, and then we try it another time. And again, you can't use any one of these things on their own. It's about how they all help you understand the story of where the market is perceiving fair value, how fair value is moving around, all that stuff. Each one of these things I showed you today, guys, are just tools for understanding context. None of this will help you execute any trades at all. It will simply help you understand market context. All right, guys? Hope you understand that. Take care. Bye.